Welcome to the first of our sessions. This will be improving employee financial wellbeing during a recession. And I'm delighted to welcome Gethin Nadin, best-selling HR author and Director of Employee Wellbeing at Benefex for this session. Welcome, and over to you, Gethin.
Thank you, Maggie. So good morning, everybody. Hope everybody is keeping safe and well. What I'm going to talk about today is, as we enter the early stages of recession brought on by the pandemic, employees are facing old familiar challenges and brand new ones when it comes to their financial well-being. The way the pandemic has affected all employees differently and the lessons we can see from previous recessions have combined to create a perfect storm that will continue to impact all areas of employee well-being for years to come. But over the next few years in particular, employees will need the support of their employer more than ever before. And with little support elsewhere from the government and charities, etc., employees have turned to their employers and their reward and benefit schemes for support during what is probably one of the most difficult times in their professional careers. But I think there's a huge opportunity for employers to enhance their employer and consumer brands, eliminate the drop in productivity we've seen and absenteeism caused by financial stress, and to be a source of valuable support to our people. And I think those organisations that commit to supporting the financial well-being of their people over the next few years will reap those rewards through increased loyalty and engagement. Just before we started, I just wanted to clarify what financial well-being means to me. It's become a really marketable term, so I think the market has got very different ideas of what financial well-being is. It's been hijacked by marketeers to mean saving, borrowing, advancing salary, employee benefits, investing, financial advice, and everything in between. But the reality is, to me, financial well-being is a state of mind. It's not a product. And while these products may help certain employees to feel better and more control of their financial situation, they themselves are not financial well-being. I believe financial well-being is when we have control over our money that comes in and goes out of our lives on a regular basis. And I think it also means we have the resilience to things that will happen in our lives. So when we need to call a plumber, when our kids have a school trip, when our car needs work, these unexpected expenses can derail our financial well-being. So making sure we're prepared for them is a significant part of how we feel about how our financial well-being is going. But I also think it's part of how we feel about the part money plays in our lives, that money should be seen as something that can free up time for us, or the ability to do the things that really mean something to us. It should be seen as a positive enabler in our lives, not something that's confusing and scary and taxing to deal with. And I think there's a unique opportunity for employers to play a role in getting people to change the relationship they have with money so that they control it rather than it controlling them. And I don't think there's ever been a better or more important time for us to commit to that than a pandemic and the recession that have heightened financial anxiety. So despite this being the largest global health pandemic ever, it's not our physical health that's actually been affecting employees most. In fact, most are worried about the long-term financial impact on them and the economy than they are about their physical safety. People are more worried about money than they are about catching the virus, according to the latest research. And long before coronavirus was a thing, the UK had record high debt and a stagnant savings habit. Like most of the world, we'd just recovered from the last recession and we're incredibly ill prepared for another. Young people in particular, those under the age of 40, I turn 40 next week, so that's still young people in my book, were feeling the effects of the recession just over 10 years ago that affected their retirement savings, house buying plans and long-term debt. But at the start of this year, 6 in 10 Brits said they regularly run out of money before payday, with just 50% saying they could only go a month or less without having to borrow money if they lost their job. And then the pandemic hit, and 85,000 Brits lost their jobs. For millions of others, furlough saw wages drop by 20%, while others continued to work on reduced pay. And the reason the UK government was so quick to instigate the job retention scheme was that they knew how well ill-prepared people were. Decades of slow wage growth saw people in the most precarious financial situation they've been in for years. And then a pandemic hit. Money worries are now the biggest well-being concern for employees in the UK and most advanced economies around the world. Brits are more worried about money than usual, with many saying their feelings are hounding them. This increased financial anxiety is contributing to record levels of depression and anxiety as money worries start to spread to other areas of well-being, including physical, as the stress of money causes lack of sleep. But more than half of employees now say finances are their biggest wellness concern in the wake of the coronavirus pandemic. That's more than any other aspect of their well-being. And that's kind of quite significant, I think. A global health pandemic hit, and yet the biggest wellness concern isn't physical, it's financial. The long-term impact on employees is even harming retirement. As we can see, the research tells us that 20% of employees say they've reduced their pension contributions or withdrew money from their retirement savings in certain countries around the world. For those of you that manage international benefit schemes, some countries have allowed employees to draw money from their usually restricted retirement savings. And so concerned have they been with this practice that the OECD have spoken out about it and warned employers and employees that they may be setting themselves back a decade by doing so, and has asked governments around the world not to allow these practices to continue. But these growing money worries are inevitably having a large impact on the mental health of our employees, and the effects we expect will last for some years to come, as we've already heard earlier today in this conference. This is why for the foreseeable future, if you don't have financial well-being at the centre of your well-being strategy, your well-being strategy will simply not be effective. And one of the big lessons we saw in this pandemic is how poorly protected people were for an event such as this. But it didn't have to be that way. Employees are generally poorly prepared for job losses, ill health, death of themselves or a spouse. 80% of people with a mortgage don't have any income protection in place. It's a big misconception in the UK that those applying for a mortgage must have income protection in place. But of those that do, half of them say they felt pressure to take out this insurance without really understanding how it worked. And these kind of practices that your employees experience as consumers is what's driving the low levels of trust they experience within financial services. So there's a unique opportunity at work for us to positively exploit that trust and be a source of truth and education for employees. And for those that had it and unfortunately died from COVID-19, life protection paid out and ensured their families were supported. Every single claim in the UK was paid. En masse, employees started to see that these previously stale and old-fashioned benefits could actually start to make a significant impact to their life and how valuable they could be to ensure themselves against poor financial well-being in the future. And I'll come back to protection shortly, but what the pandemic has done is made employees much more aware of their well-being and the part their employer has to play in getting products and education about benefits to them. I think post-coronavirus, research shows us that employees are now much more likely to say their employer has a responsibility to help them with their well-being, especially when it comes to financial well-being. And how most employers are starting to do that, we can see, is through their benefit schemes. If we were to draw a line through the middle of most UK benefit schemes, roughly half would be related to health and half to finances. At Benefex, we believe, based on our research and experience, that benefits are a significant part of employee well-being. And through the pandemic, our data showed us that almost every customer turned to their benefit scheme to offer better support for their staff. We saw huge increases in traffic to our One Hub platform, and 2/3 of employers now say they intend to increase their benefit spend in the wake of the pandemic and introduce new well-being benefits to their people. But as employees have turned to their employers and their benefit schemes for support during this difficult time, quite a few have been disappointed with what's on offer. Around half of employees say they feel their employer doesn't offer the benefits they need at this time. And employees have realised that some of the perks they offered were just gimmicky and don't actually offer any real well-being support to them when they need it. But when we look at what employees really want, we can see that half of the most desired benefits are finance related. Apart from things like flexible working and more annual leave, employees want more insurances and they want better pension contributions. But the latest research also tells us that most employees still believe their benefit schemes are too complicated. It's been a recurring theme in my experience, especially over the last few years, but there is clearly a very big role for employers to play in helping people to understand what is available to them and how these benefits work. During this pandemic, employee benefit schemes have played a significant part in how well-being has been delivered to employees, but also where both employees and employers have gone for support. The recent evidence before the pandemic shows us that actually, do employees really understand the benefits that they offer, and do they fully appreciate what they don't understand? A quarter of people sign agreements without understanding them. Most employees don't understand common insurance, and pensions are still incredibly misunderstood and confusing. So when we talk about financial well-being and financial education at work, what is often missed is that this isn't just about getting employees to understand debt and loans and mortgages. It's about the things you offer them, the benefits most of you are spending 20% of your global payroll on. And are you making the most of that investment by ensuring your people actually understand what you're offering them? And the research tells us that actually most employers aren't. And part of that might be because we treat everyone the same. At some point we started to feel that treating every employee the same was the fair thing to do. And while the pandemic and the recession will affect us all, the way it will affect us differs greatly based on our diversity. The pandemic further highlighted the need for rewarding benefits and well-being to be more closely focused on diversity. And for a plug for Maggie, she's written a great article on REBA about this, so check that out following this talk. Following the recent BLM protests, the diversity of black employees has had the spotlight shined on it, and that should apply to your benefits and well-being strategies too. The coronavirus pandemic is adversely affecting black people more than white for a variety of reasons. But for a long time, the financial well-being of black employees, even those who are educated and more affluent, has been missed by employers. According to the findings of the Race Disparity Audit, 1 in 5 children in black households live in persistent poverty in the UK. And for those that aren't in poverty, systematic inequalities mean that there are limitations on earning and progression potential, which all increase the risk of falling into debt and make it harder to get out of. Almost every single black and ethnic minority group of workers are paid less than their British white counterparts. White British workers earn on average about 4% more, and the gap rises to a massive 20% for some ethnic groups. And this means that ethnic minority groups affected by this pay gap face a higher risk of getting into debt. So it's clear that the existence of a racial debt gap in itself leads to much bigger wealth gap between black and white households in the UK. And unwritten structural inequalities are fueling this resulting gap. But let's just pause on that for a moment to think about the other diversity and how these things go well hand in hand with well-being and financial well-being. Our experiences in our life mean our problems associated with the money are different based on things like racism and homophobia, and they prevent many from seeking the help they need. Women, for example, are far less likely to get financial education support than men, and as we know, throughout their working lives, from pensions to income, women are at a significant disadvantage. So who is at most risk at the time of economic crisis and recession? The data tells us that it's actually young people, women, and the less educated. This isn't because of low pay, unemployment and pay inequality, although those factors clearly don't help, but because surveys show us that these groups typically have low levels of financial literacy. Data from almost 20,000 respondents to a 2016 Household Income and Labour Dynamic Survey show that 1 in 3 adult men and 1 in 2 adult women struggle with basic financial literacy concepts such as compound interest, inflation, and diversification. And of those younger people, only 44% of men and 24% of women can correctly answer a question covering those 3 concepts. But for the sake of this presentation, I'm going to focus on one area of diversity that most organisations are particularly conscious of at the moment, and that has to be black employees. When it comes to diversity and well-being, the two are pretty interdependent, and this means that any financial well-being strategy needs to be aware and allow for the huge inequality that exists between the finances of black and white employees. UK home ownership rates for black families are less than half that of the national average in this country. What this means is that more black people are renting and therefore spending larger portions of their income on housing than those with a mortgage. And these modern day financial disparities, such as the 45% of black people who report experiencing racial discrimination when trying to rent an apartment or to buy a home, continue to make economic mobility and wealth building more difficult for black employees. But even for those affluent and experienced and educated black employees, black male graduates will be paid less than their white counterparts, and they carry more student debt too, which is just ridiculous when you think about it. But in order for us to really understand how financial well-being is affected by skin colour, we need to look at the disadvantage your black employees have as consumers. So black people, even those who are more educated than white people in studies, found that they are more likely to be given costlier options when buying car credit. Just one example of the ways in which diversity impacts financial well-being. In their 2019 Insights report on how to build financial inclusion for black employees, McKinsey & Company conclude that the employer has the best opportunity by surfacing the right tools, products, and education to their black employees. The reasons racial financial wealth gaps can be complex, but a new report from the Global Financial Literacy Excellence Center in the US says that actually addressing these disparities may be found by increasing financial literacy. Ken Fraser, the gentleman on screen, is the first African-American man to lead a major pharmaceutical company. He's the CEO of Merck & Co., the second largest drug company in the US. And Fraser believes strongly that education is critical to reducing the racial financial gaps. And education must account for this diversity. If you want to take well-being seriously, if you want to make the best of your benefit spend, and if diversity and inclusion is important to you and your business, the areas where these things collide must be addressed. Before we move on to financial education, I just wanted to talk briefly about how employers should measure success. And I think this begins with understanding that in many cases, our financial well-being is less concerned with how much money we have, but rather how we feel about our financial situation. When we look to measure financial well-being, or indeed any area of well-being, I think, when we basically looking at two measures, subjective and objective. Basically, the things we can prove through raw data, and then the way employees are telling us they feel about their well-being. High levels of financial literacy are positively associated with high levels of financial satisfaction, while negative financial behaviours are correlated with lower levels of financial satisfaction. And the research in this area suggests to us that subjective financial knowledge has a strong relationship to financial satisfaction than objective knowledge. So how people think and how in control they feel of their financial situation is sometimes more important than what they actually know. And the research again tells us that desirable financial behaviours increase financial satisfaction, while risky financial behaviours decrease it. And my analysis of the most recent research in this area suggests that financial behaviour and subjective financial knowledge are stronger predictors of financial satisfaction than perceived financial capability on its own. However, governments around the world, led by people like the UK and New Zealand and sometimes Britain, have taken a more subjective view of national happiness and well-being as more of an accurate way of measuring the success of our societies. And we've seen employers are now starting to follow suit, and this method is now being used all over the world by governments, the UN, World Health Organization, and the ONS set up by David Cameron many years ago. So the way we feel about our financial situation is an area that employers should focus on helping their people to improve. People make social comparisons, and when they're drawn, they tend to be made laterally with others in similar situations. So it's more to do with the way we feel, and making employees feel powerful starts to show us that actually we can influence financial education quite significantly by controlling the things that we can in our lives. We can't control the world, but so we can focus on the things we can control. And that's what's in our behavior and our financial behavior specifically, the things we have the power to change. New research shows that those in control of their finances feel generally calmer, happier, and less worried. Aviva reported this year that overall happiness and self-esteem are influenced by our sense of financial control and not how much money we have or how much money we earn. And financial security, maybe more than money alone, may be the key to happiness, according to one Princeton study. And this is huge support for employers that want to be able to help their people feel in control of their finances, because they understand their options, they know what they need to do, and they can start to make a plan. And this is just as important going forwards in the absence of recession as how we use money and how it's changed our behaviours. So as I mentioned at the beginning, the pandemic has had a significant effect on all of us. But as we've seen, some employees are being affected differently and some are worse off because of this pandemic. The impact the virus has had and having on the lives of employees will be felt for years to come. But what we can see is it's starting to come back. So the initial reaction that employers gave to help people with their financial well-being and their overall well-being started to have a significant impact. But actually that started to fall again since July as we got used to the pandemic. And managers' employees are now around 20% less likely to agree that their organisation cares about their well-being. An example of how financial well-being is being impacted in ways we couldn't have predicted. We're using technology more when it comes to our money. Cash machine use has more than halved in the UK. During lockdown, almost 100% of people used a mobile wallet. 90% say that they're currently using that. The UK is now expected to be cashless by the end of the decade, based on the advancements we see people using in current parts and the recession. And that's concerning for employers because the research that people feel control when they spend than when they have physical money to spend. I'm conscious of time, so I'm going to lip through a few of these. So my advice is encourage employees to create a savings buffer. Higher savings reserves mean that consumers have cushions that can help absorb overwhelming expenses without digging the holes deeper. And we will share these slides with you, so if anyone doesn't have time to read what's on the screen at the moment. Borrowing money should be a last resort. The last recession was triggered by the collapse of an enormous credit bubble, fueled by lowering their standards to take on more borrowers. Over the next few years, I think employees should be cautious of borrowing money. The latest research shows us that when we have more credit available to them, they are significantly more likely to use it. And financial well-being is avoiding the difficult financial positions in the future. The largest debt report in the UK tells us that most problem debt is caused by a common collection of predictable life events, things that we can insure ourselves against. And people don't understand insurance. They find insurance need to come from a trusted source. And again, as I've explained, this is where the employer has a role to play. And invest in financial education. The biggest and most important lesson from previous sessions is the need for everyone to get better at understanding their money. The OECD say that in the wake of the coronavirus pandemic, even in the absence of the crisis, developments in financial markets, demographics, economic and policy changes all point to the importance of financial education. So in summary, how much did financial literacy contribute to the last recession? According to lots of experts, pretty significantly. During recessions, financial literacy becomes really, really important. And we're in that situation in the UK at the moment. But it needs to be used in the right way. Information needs to be relevant. We aren't able to just store information in case it's useful in the future. It has to be timely. Employees need frequent reminders of the support that's there and also where they can find it. And we need to create strategy that aligns to employee benefits. We need to use life events and third-party tools as well as individual benefits. And most importantly, we need to build a home for well-being. We need to design an environment that encourages healthy behaviours.